I'm Matt Bichard here in Chicago for the Real Estate Research Conference and REITWeek 2013. Joining me is Merrie Frankel, Vice President and Senior Credit Officer with Moody's Investor Services. So in a nutshell, how would you describe the state of the real estate credit markets today?
I think the real estate credit markets are doing very, very well. Basically, in a nutshell, I would say they're stable and liquid, despite the uncertain macroeconomic environment going on around it.
And Moody's has done a number of new ratings this year. What are the challenges in rating a new company?
It's been a really interesting year. I think as a result of the recession, a lot of companies who had not been rated previously realized that it's really nice to have access to that fourth quadrant, the public bond markets. So they've been setting up their balance sheets to be able to come in and get a rating. And we've been fortunate this year. We've had so many new ratings. Probably, and although we've been doing a lot of new ratings throughout the last number of years, I would say this year there's been so many. It's probably analogous to the 90s when REITs were just this new REIT era when it was IPOing. But I would say really the challenges are primarily for the companies in understanding us, what we're looking for, that it's not a black box. We have a methodology with about 16 elements, and qualitative as well as quantitative, and that basically setting themselves up to be rated, looking at their debt maturity schedule, and I would say probably the number one issue is how much secured debt they have, because we do look at the amount of secured debt to gross assets, and probably looking at when they can start paying down some of the mortgages on their books. And we've had a few companies recently, like CBL that we rated a few weeks ago, Baa3, and we were able to see in their projections, they have a nice debt maturity ladder where over the next few years they are going to have a window period and be able to pay down some of these mortgages and unencumber their portfolio, and then at some point go out to the public bond market. So that worked in there. They have this window period and it worked nicely. On the other hand, we just rated last week ROIC, Retail Opportunity Investment Corp, and I would say the great majority of their portfolio, about 87 to 90%, was already unencumbered. And they'd been actually, since they started up in 2009, they had actually been positioning themselves to come for a rating at some point. And Stuart Tanz, having run Pan Pacific previously, understood the whole rating, methodology and whatever, and his team. So they didn't have that same issue of having to unencumber properties because they already had a number of them unencumbered. So you find companies that have been setting themselves up and others that have thought about it more recently, but it's been really an interesting process.
And in 2012, we saw a number of REITs really focused on deleveraging their balance sheets. Is there that same focus on 2013, and do you expect that trend to continue?
The answer to that is actually yes and no. On the one hand, companies realized as a result of the recession that having less leverage is good. It gives you the ability to go out and mortgage a few properties if you need to. But the second part of that answer is with interest rates being so low, what companies have been doing is redeeming their old preferred and issuing new. The bond market has been going like gangbusters and issuing equity. And in fact, your NAREIT stats show that last year there was $73 billion of issuance, equity preferred in bonds. And so far, by the end of May, there's been about $41 billion this year. So we seem to be on target to at least meet last year, if not surpass it. So as to the question, are companies delevering? I'm not quite sure as much as we thought they might, because what's happening when you're redeeming the old and issuing new at lower interest rates, basically you're going to bring down your interest costs, your fixed charge coverage is going to get better, your net debt to EBITDA is going to get better, but is your overall leverage number going to change? Not necessarily.
Well, Merrie, thank you so much for joining us today.
Thank you. It's a pleasure as always.
For more on this and other REIT news and analysis, be sure to visit REIT.com.